wanted to connect with you guys about government review. Really, I want to go over a government on a deeper level today. And what I wanted to do, I prepared this presentation about government 1 and 2. And what I wanted to go over is, in a way, like on a deeper level, get into the government accounting that we've been talking about. And what I gave you guys just now is a CPA practice exam just on government. And I was going through it. This is like for, how many guys have taken the CPA exam? So for government, this is a big section on the exam. And basically, going through these questions, I realized that it's in a way, the way we've been studying the governmental stuff is just like an intro. And you'll see that this is almost like another level of knowledge that is a little bit higher level of knowledge. So in a way, I want you guys to use, I'm going to go through and really sort of guide you guys through a deeper understanding of the government stuff, using examples and using explanations and other things. And so then what we're going to do is I wanted to go over the homework, government 1 and 2. I'm just going to go through the questions really quick. I'm going to ask you guys to give me feedback on the questions also, like what you think. So I'm going to bring that up as well. And then, so the lecture is based on giving you hints to the answers in the test that you guys have in front of you. So I embedded throughout the PowerPoint that I'm about to go through for the next 30 minutes, I embedded a lot of answers to the questions that are in the pamphlet that you have there. So what I want you guys to do as I'm lecturing also, like in a way, read the problem, the main initial problem, and read through a couple of the questions, and then you'll be seeing a lot of clues to the answers in a way to what you need. And then last 15-20 minutes, I'm going to organize you guys into teams. We'll have about 7 teams. And on the board, I'll have you guys work in groups for like 5-10 minutes. And then we'll start playing Jeopardy, where these are the questions and these are the points assigned to the question. And then if you get it right, you get the points. If you get it wrong, you get that same amount equivalent points negative. That's what the parentheses, in accounting, like the parentheses, yeah. So, so basically, and then, the 3 winning teams are going to get a prize. Right now it's secret. It's a secret what you're going to get. But there's going to be a prize for the top 3 teams. The top 3 teams. So you have a really big shot at making something big happen today. So, I know it's almost the holiday, so we need to bring an extra amount of excitement here. Because you guys are ready for sleeping in and all that good stuff. All right, so I would say, in a way, listen, just focus on the first 25. I'm not going to really go into the whole 38. I honestly just focus on the 25. And it's not a lot because each question is true or false. And a lot of like 4 of them will be the same exact thing, just in a different context. And it's also, I think it's a good practice for the CPA exam because it gives you a flavor of where they're at. It's where they're at. So when you study for the final, you could really get a little bit of an understanding of also, if you want to invest a little bit, really understand, but, I need to study it a little bit on a different level because now is the opportunity to synergize my studying for the advanced accounting final and my studying for the CPA exam. There's a synergy there because, you're going to use this stuff again and probably even on a deeper level that I'm going to ask you. So this is, in a way, you can turn this into a great opportunity, this whole studying for the final thing. So, and then what I'm going to do is I have answers for you guys for this packet. It's a different handout I'm going to give to you guys later at the end of class. So I'm going to leave you guys after you go really deep into this with your team, and then we'll play Jeopardy. I'll leave you guys with the solution to this practice test to take with you for the weekend and for next week, so that the government stuff, in a way, you can use this as a practice exam, in a way. Because if you understand this stuff, you really understand government. So I'll give you guys the solution so that you can really go through it, like really have a practice exam. So the first thing I wanted to go over is modified accrual accounting versus accrual accounting. So we use accrual accounting for governmental-wide financial statements, and we use modified accrual accounting for the fund financial statements. So in accrual accounting, basically, we're looking at things just like regular GAAP. If I know of something, what is the rule of accrual accounting, in a way? For revenue, right? For revenue. But in a way, the accrual accounting principle from the methodology of accounting is basically says, if I know about it, then I can account for it. And I should do it in advance to the degree that it is possible. Now, a lot of accounting theory of the study basically uses that like logical principle in the mathematics that we deploy for numbers. But in modified accrual accounting, that logical principle is a little bit different. It says basically not so much that if I know about it, I'll accrue for it. It's more like I will accrue for it in the period that it's applicable when it's applicable. So in a way, it's more interested in correlating to the period of like when funds are actually coming in to when you can actually record it. It's not as concerned about recording way in advance using all these amortizations and accruals and things like that. So, and we'll go over a couple of examples, because modified accrual, in a way, it's more about specific implementation of it than defining it. So I'm gonna go through it. So the statements that are involved: governmental-wide financial statement, statement of net position, and a statement of activities. Fund financial statements, you have a balance sheet, statement of revenues, expenditure, and other changes in fund balances. So this is basically something to just know in terms of what is required if they start asking what is required between these two statements, between these two. Like, how do you know what each statement includes and doesn't include? And I know I keep going over it, but in a way, it's kind of like really getting into the depth of the differences. For example, I'll give you an example. In the fund statement of revenues, expenditures, and other changes in fund balances, you know, if you understand with fund accounting that funds don't really have assets and liabilities, like, which is what we keep going over, like funds don't really have assets and liabilities. Funds just include current resource expenditures, and they include just current simple assets, liquid assets like cash and receivables and liquid investments. So if you start looking at that, there's three components to really like this statement of revenues, expenditures, and fund uses and sources, which is basically revenues for funds. And revenues, there's 5 types of revenues that we're going to get into a little bit later. And each revenue type, in a way, we're going to go over through the legal restrictions into actually how to record it and when do you not record it. But then the other piece is expenditures. Like, we're really going to study expenditures. And if you see this practice test, the authors go into like this extreme detail and like really nuanced, subtle approach to defining expenditure. It's amazing because it's really what I would say from what I've seen, like what we used to do in hedge fund accounting when we had to really classify what is going to be capitalized, what is expensed, what can we pay for versus what is paid by the investors. I remember really always testing the legal document by many people and saying, what do you think? Or what do you think? Because we didn't know. We didn't know until a group of people really like interpreted. And here it's also nuanced like that. Like, is it an expenditure or is it a use or source? Because besides revenues and expenditures, since funds they're not autonomous entities. Funds are entities that are dependent on other funds and are dependent on other components of the government. So how do funds primarily get funding? They get transfers. They get transfers of funds, and that's basically a source of cash, and you'll see that, a source, an influx of funds, and that could be like a transfer in, right? And a use of fund is when a fund sponsors another fund and it uses cash for that. So notice, just like on the cash flow statement, it's really important. In the cash flow statement, when you look at a cash flow statement of a company compared to the income statement, what do you realize? What do you see from a cash flow statement? Cash that comes in. But what else in terms of, sometimes if you get into really examining the company's habits, the way it's operating, you know what I mean? Like, what would be the difference between General and Electric and a company like Facebook in terms of the way they use cash? Anybody have any idea? There would be very dramatic differences on the cash flow statement. Equipment purchases. And this is huge for valuation of companies. GE has been negative cash flow for years, from 2000 on, or for decades. Why? Because they're constantly building this massive technology, medical equipment, power, wind generation. They're taking in cash and they're spending all of it on massive capital projects. Not that their earnings negative. Their earnings positive, but cash flow negative. Because they're borrowing in order to invest. They just happen to make really profitable investments. But it's really interesting because their net present value unfolds over decades. Investments that were made good in the mid-90s are now yielding 20% on that capital. So they just happen to be really good at picking good projects. But they're very cash flow negative because they invest it all. Companies like Facebook, Apple, Cisco, Microsoft, what do? They're cash rich. They're cash rich because they are primarily selling what is known as software or non-capital intensive products like service. So you see those companies with tens of billions of dollars on the balance sheet and paying out huge dividends because nobody knows what to do with the cash. So that is something that an analyst sees on the cash flow statement. This has nothing to do with balance sheet or income statement. So we have fund financials, current financial resources. So if you look at funds, again, what is the purpose of fund financial statements? It's basically to show the expenditures, to really summarize the expenditures, and really to summarize how much revenue you claim. And revenue, we'll look into what is revenue that's been claimed versus revenue that's not claimed, right? So that's, in a way, that's the idea. But you cannot get funds right because it's a closed system until you get into transfers, right? So you have to understand how much money got transferred in, which is non-revenue transfer, which is like, for example, for Rutgers, there was a transfer from the state. So you're like, okay, whoa, like money just came in. Where is that revenue? What is that? And transfers out, which is like, oh, I just sponsored some other fund or some endowment or something. I transferred. And you have to understand how that impacts your net balance and distinguish those from revenues and expenses. So that's sort of, on a deeper level, what we're dealing with government is not just like looking at the statement and like saying, okay, this is the statement. It's more the classification of the expenses, of the accounting items according to the legal literature that we're witnessing in these chapters in terms of this is this one, this is that one. Because, as you notice on a subtler levels in accounting, a material misstatement doesn't just come from a number error. Most of them come from classification errors. You classify this as an expenditure, but it's really a source, right? So what does that happen? Now you have a P&L effect by that amount. Now you have an equity effect by that amount. Now that is a mistake, because basically misclassification is in a way what we're dealing with here. So we have inflows and outflows. What are major funds? Just want to go over what are major funds. It's when it's 10% of the total government fund and 5% of the total government fund and the enterprise fund. So it has to be basically 10% of government fund and include 5% of the government and enterprise fund for some fund to count it to be a major fund. Okay? In terms of some fund definition stuff, proprietary funds contain both enterprise funds and internal service funds. And business activities are at least the amount of proprietary funds. So you know how in government-wide financials we have governmental activities and then we have business-like activities? The business-like activities have to be at least the amount of the proprietary fund balance. Because the proprietary fund, what does proprietary fund do? Like Port Authority. So business type is equivalent to proprietary fund, right? But you can also have enterprise fund and internal service funds that can also have business-like activities. The proprietary fund is not the only type of fund that does business type activities. You could also have this enterprise fund that does that. So just to go over these one more time. So the general fund, if you look at the distinction, what kind of funds are there in government? General funds, proprietary funds, and fiduciary funds. So if you break it up into that, what is the general fund? What is the general fund? The general fund is direct service to citizens. So we're talking about general fund is police department, fire department, health department, library, anything that's directly interacting with citizens, right? Proprietary funds are funds that are now engaged in business. Port Authority, Turnpike, Subway, New York City Subway path. And then you have fiduciary funds, which is trust funds, pension funds, funds that are not included in the financial statement complex. So those are the distinctions at the general fund level. Special revenue fund is when funds are allocated to a project. So basically, special revenue fund is when you have a fund that's generating revenue, and it's generating revenue in a way for a specific project. I think like a bridge, or even the maintenance of a bridge. This is special revenue fund. Basically, it has its own revenue source. Capital projects fund. It's a building project. It's a building project. But you notice, like in the test, like it's a project for a capital project. It's a fund for a capital project, but it can accept revenue directly. It can accept revenue directly. It can make investments on behalf of that revenue. It can record revenue. It can have sources of revenue coming in from other departments, right? It could be transferring some of those sources to pay off debts that are located in other funds, right? If you start looking at it on a deeper level, you can start seeing it's like a labyrinth of activities that are going on between all these funds. They're all talking to each other. In a way, it's incredibly inefficient. Because you see that, right? In a way, it's incredibly complex and inefficient. I mean, there's a neatness about it. There's something like intricate about it. But I gotta tell you, to actually do the accounting, it is incredibly complex because like who's talking to who and why are they talking to each other and did they forget? In a way, it would be much easier to just run the whole thing together. But this is all set up to prevent fraud, to prevent misuse and abuse, and to have accountability and to have controls. There are so many controls in place to prevent fraud. In a way, the whole thing is set up like a county bunker. Like, you know, you cannot have funds missing without all these red flags being triggered in many, many places right away. So you see it's kind of brilliant the way they did it, because it's really, really hard to steal money from the system. And maybe it's really easy too if you really know your way around it, but proprietary funds, at least at business-like, enterprise funds are business-like, and service funds, there could be related to that. So types of, so in terms of restrictions, I know we talked a little bit about these restrictions, but what is the real difference between committed and assigned? For funds to be committed, the highest governmental authority within the entity complex needs to have signed authority to have spent these funds. As opposed to assigned is a lower level official budgeting the assignment. So committing funds in the example of what you're looking at in your hands there is basically, it's not going to be at the level of, I think they're talking about the police department, it's going to be more at the level of the highest governmental official for it to be committed. Because committed means it's already been encumbered. Encumbered means that the funds has already been approved to be spent. As opposed to assigned, which is kind of like an opinion, not a solid execution of budget. In terms of budget, when we enter a budget, what's the budgeting entry? The budgeting entry is basically it's revenue. It's revenue on one side, and allocation of funds to the other side. So in a way, it could be debit. It could be debit like cash, right? And credit allocation to funds. But it's not expenditure. You know, when you create a budget, part of the budgeting is basically the recording of future funds that you will have, in a way, revenue, and allocation of where that revenue will go, which is other funds. Not expenditures. In a budget, no money is actually being spent, right? You're just allocating the revenues that you expect to receive to other funds that you already know will need the money. I wanted to go over one more time. Purchase method versus consumption method. Which method will show more assets on the balance sheet? Purchase method or consumption method? Purchase method, because in the purchase method, it's consumption method. It's consumption method because in the purchase method, whatever you purchase, you expense right away. Whatever you purchase, you expense right away. So there is no assets. Whatever you purchase, done. It's an expense. There's no capitalization whatsoever of the assets involved, right? Now, what is the consumption method? You capitalize the whole item, which means you record it as an asset, and you expense according to the use as you go along. So, which one will show more assets? It's the consumption, because it records it and then it weans it off as you use it. So the purchase method won't record it at all. There won't be any asset, right? So that's a nuance. There's a question there. If notice the nuance there. So I think with revenue recognition, it's really going to become clear as you go through. There's like 6 to 8 questions out of these 25 that are on revenue recognition. So I want you guys to really like jump in there and really learn about the revenue recognition. All those questions about 98 days later with the rest of the balance written off. Really read the nuance, because you see like on the CPA exam, you see like the intention is to trick, right? So it's like you can see, it's amazing, like they're really testing you not for knowledge of the material, but your superiority with navigating the knowledge, right? They're not interested in you knowing the definition. They're interested in you knowing how to navigate through the material. You'll see that in the questions. They like the stuff like which one is which is derived, which is non-derived, which is imposed, which is non-exchange. That's not what they're asking about. They're asking about the subtleties of applying the concept between government-wide and fund, which basically they're saying, how do you treat non-exchange revenue transactions between income tax or property tax in accrual versus modified accrual? So they're talking about are you gonna record it when it's accrued, or are you gonna record it when it's basically yours and due, and to what extent? I would say to this one, notice the 75-day restriction that they talk about in the beginning of the problem, and they say the 75 days is basically their revenue recognition policy, and with the 75 days is when what they consider what they consider available for a resource, available to be spent in the foreseeable future. So if they can ascertain the resource, then they record it. If they can ascertain. And what they do is they don't look further than 75 days. As opposed to in governmental wide, you see that they're looking for the whole 98 days. So just look at that subtle distinction between what is available to be collected now, as opposed to something that our own revenue recognition policy says that there's a limitation on that. Measurable and available revenue is recognized. And notice that the other revenue is deferred as a liability. So I think it's a really excellent question, because it discusses between that 98,000, the breakdown between the 75 and the 23. The 75 becomes like, in a way, an earned revenue amount that you can record, and the remaining piece, the 23,000, becomes deferred revenue, which is revenue that you might have but is not yet earned, right? Like when companies sell you software in a way that for 5 years, they don't earn the revenue on the software until time expires on the use of that software. So it's kind of like, even though you have claim to these dollars, you're not going to actually earn them until the time period comes close to the time period that is in your revenue recognition policy. Are you guys loving this lecture? This is like, it reminds me of some of these EY lectures on technical accounting sometimes. For 8 hours. What is FAS 133? 2-day workshop. And it's like that for 8 hours a day of just technical accounting, nuanced concepts. Another thing that you need to be cognizant of is the transaction flow. If you notice, they want you to be fluent in the transaction flow of fund accounting. And for that, you wanna understand that question with the police academy expenditure for equipment, in terms of what are you encumbering versus what are you spending, and to understand the concept of encumbrance versus spending. And I'll give you a personal example of an encumbrance, right? Say you're gonna go out on a date, and you're gonna pick up the bill, right? And you budget. Listen, I only have $40 $40, reasonable. I mean, it's a first date. So it's a first, no, you don't know. So say it's $40, and so say you know this in advance. Right? So $40, you know this in advance. You need to make sure you have the money. So in your mind, you said it's already, it's going to be $40. And then you get to the movie theater, get some food, a drink, you're $78 in. So you're like, okay, well, I'm definitely over budget, right? So in a way, that's okay, because it's on my debit card, and I might have less money next week. But that's fine, because it was a great time. But in a way, so what is the encumbrance and what is the expenditure? Anybody can tell me? The $40 was the encumbrance and the expenditure was the 78. So in a way, the encumbrance was 40 and the expenditure was 78. So if you look at that application in the problem, you'll see it. So it's kind of like $40 was a debit, initial debit to encumbrance. So what is encumbrance in a way? What is encumbrance? It's a lien on your funds in the form of something that appears like an expenditure, right? But it's not an expenditure. It's a lien. It's a lien on your assets, right? In other words, say your account is running on like zero, basically, right? And you're only in the debit card world, right? So in a way, and you have a date coming up. So in a way, like you might not clear, when you go to the movie theater, that's awful. You should have gone to a cup of coffee, right? But the idea is, in a way, if you encumber the funds, then there's no way that would happen. So that's what the government does, is they always encumber, because they have no idea who is trying to get a hold of these assets, because there's so many, it's decentralized authority. There's so many people trying to get in on the funds, because everybody wants something. Everybody wants to spend the money. It's a pool, isn't it? So encumbrance, in a way, is a genius way to put liens on funds, right? And you have to, in a way, mentally, wouldn't you have to do that if you're going to go on this date and you're running around close to zero? In a way, and 2 weeks beforehand, you have to encumber this money or do something with it, and to the degree of the what you decided the budget is, and have that money put aside, right? And then when the expenditure comes in, it should match that amount, although it usually doesn't, because budget and actual is always different, right? So that is the encumbrance. The encumbrance process is really a process of creating a priority of payments toward the assets that are to be spent. So it's basically a hierarchy of spending concept. And in a way, it has to be done. In journal entry format, how does it happen? It happens in the form of a debit to encumbrance, credit to a future payable, right? And the way do you reverse the encumbrance, right? So I debit $40 for the encumbrance toward future first date, credit future payable, right? Then I go on the date and I spend 78. What do I do now? I credit the encumbrance account because I had a debit there, right? I credit because I need to release the lien. The way you reverse out the encumbrance, the purpose of reversing out encumbrance is to release the lien, because the lien is no longer applicable if the expenditure has already been performed. You have to sort of understand the budget procurement process. The budget procurement process is first policy allocation of funds, then individual allocation of funds to that expenditure, then spending of funds on that expenditure, and then assessing the budget, the actual of that expenditure. So in a way, we're talking like the government is basically, what they're doing here is a form of internal accounting and external accounting in the same system. Usually what you notice when you start really getting into accounting, you notice that there's external accounting, which is sort of GAAP and what we talk about in public accounting, financials, that's external. But internal reporting companies do is way different. They do it for themselves. That's more like cost accounting. Like you want to figure out what's going on in your firm. Like how much is this costing me? Nothing to do with reporting to shareholders. So this is part of that. So you release the encumbrance by crediting 40, and then you debit expenditure for 78. And that excess of 38 is captured in the 78. So this is basically a summary of that. So what about revenue recognition? What about revenue recognition? So there's a couple of requirements before revenue can be recognized as revenue. And what you start noticing is there are several restrictions. So one is basically they can say your money needs to be spent in a future period. So your revenue will be recognized in a future period. Two, you have to comply with a certain law before you can spend the money, right? Say somebody gives Rutgers a gift, but they're like, before you have an online library of all your classes, you cannot use this $200 million that we gave you, because we wanted you to use it to create a digital library of all your classes. But you cannot use that. You cannot, in a way, like, until you get accredited by the Online Digital Standard Board, you cannot use this money. So they do this so that you can comply. Basically, you start noticing on a subtler level, you start noticing how people with money they're not just giving money, but a lot of times they're trying to influence policy. Like they're giving money, but they're making it contingent upon certain implication of policy. And I'm starting to see that a lot. Like, like maybe they gave Newark $100 million from Facebook, but they were like, oh, but you can't use it until you increase your college entrance percentage from 66 to 68. So that will basically push them to do something completely different to get something that's actually quite doable. So in a way, I'm starting to see how this is being used widely to influence policy and performance. Because performance in governments, it can be kind of stagnant because there's no profit motive. So they're trying to create different rewards type of systems everywhere. But I think governments, in a way, they're very much involved with that now. I remember, I think, did I apply, or I was interested in applying to work for the SEC. Out of EY, the SEC has a big division of accountants who basically check the audited reports, the 10Ks. So I was aware of this whole thing between Ernst & Young and SEC. There was sort of a relationship where people went there to the SEC to work there in DC or New York, whatever. I remember I applied there, and I saw they were paying accountants like $140,000 up to $170,000. So they were paying top market rates. And they were allowed to do it because, in a way, like, they are affording $170,000 for accountants because they are under a certain division of the government that has budgets because they are a performance-based organization. You know what I mean? And they're sort of using their power to get good talent into their ranks. And they loved getting Big Four people who have 7 to 9 years experience because they're dealing with highly sensitive information, like enforcing legal action. And some of these legal action, Merrill Lynch, $2 billion, they got a payment. So in a way, it's very much revenue generating what they're doing, like incredible. So, but there's parts of the government, I think the White House operates like that, of course, the Senate, there's different pieces of the government that are very much effective in terms of what you're talking about, like rewards and like really like promoting FBI, CIA. I think a lot of these organizations are using that to really make things more influential and more organized. So eligibility, we talked about. Contingencies. It can be withheld until a certain procurement action has been taken. So if they, for example, donated Rutgers money to build a building, but you haven't created the architecture design yet, they're going to withhold if you don't meet the deadline. So again, it's basically in a way it's milestones to meet all these things.